Good evening, everyone. Let's wait for half a minute for all the participants to join in.
Sure.
Good evening. A very warm welcome to all of you on behalf of Tax Sutra and AKM Global. Thank you for joining us today for this important discussion on obligations of reporting entities under the Prevention of Money Laundering Act, PMLA Act. Financial crime risks are rising fast, and the PMLA compliance has become one of the most critical pillars of trust in India's financial system. It's no longer about ticking boxes, it is about building strong internal controls, ethical culture, and business resilience. As digital payments surge and the new age instruments like crypto come into play, the expectations from reporting entities have only grown sharper. Today's session is designed to help you understand these responsibilities clearly and practically. We are delighted to have with us Mr. Anirudh Sood, lead white collar crime defense practice at AKM Global. Anirudh has a stellar academic background, a gold medalist through law school, and a specialist in criminal law. He has worked closely with the Supreme Court of India as a legal researcher to Honorable Justice Suryakant and Justice Sanjay Karol. He carries over 8 years of rich litigation experience, including a significant stint as a legal consultant and counsel for the Enforcement Directorate. During this time, he handed over 150 cases under PMLA, FEMA, and Fugitive Economic Offenders Act. He has represented the ED as a special public prosecutor in several high value matters involving bank frauds, illegal mining, and sensitive economic offenses. His deep understanding of PMLA, his experience across enforcement actions, and his practical insights on due diligence makes him the perfect person to guide us through this subject today. We welcome you, sir. And before we begin, quick hygiene announcement for all our participants. In case you have any questions, please do post them in the Zoom Q&A box. With this, without any further ado, let me hand it over to our speaker, Mr. Anirudh Sood.
Thank you so much, Anjur. Good evening, everyone. I would like to thank Tax Sutra for this collaboration and for this wonderful session. Ladies and gentlemen, I'm Anirudh Sood. I'm working as lead white collar crime defense practice at AKM Global, a firm that has been constantly ranked by the International Tax Review since the past 9 years. And this time it gives me immense pleasure to tell you and inform you all that we've been ranked as a tier 2 firm in all the three categories: the transfer pricing, the general corporate tax, and the indirect tax by the International Tax Review. The partners of the firm, they are thought leaders, they appear in the print as in the digital media constantly. Now, coming to the agenda that we're going to deliberate in this session, the reporting entities, the ambit of the expression reporting entities, who exactly are covered within the expression reporting entities under the PMLA Act. What are the statutory obligations that the reporting entities are supposed to comply, the risk and the penalties that are being faced by the reporting entities due to non-compliance? What is the significance of the anti-money laundering integrated due diligence? Then the entities that may not come within the purview of the expression reporting entity under PMLA, but we strongly advise them given the litigative experience that we hold and the kind of investigations that we have seen thus far, that would make it imperative and as a safeguarding measure for the entities that doesn't come within the expression reporting entity, but it is still advisable for them to to comply with certain certain obligations that are there, so that in future, if they are being roped in into any kind of investigation, so that they can show their bona fide. And then lastly, we'll also cover the recent trends that would highlight the non-compliance and the effect thereof. And certainly for the for the information point, from the information point of view, I would also take you to the United Nations Security Council Resolution 1718 and 2231, the delisting thereof, and what exactly it is, and who exactly is the competent authority to file for delisting. So firstly, taking you to the reporting entities that has this expression which has stands defined under Section 2, subsection 1, clause W of the PMLA. It broadly includes four categories of, you say, entities or individuals that can be classified as a reporting entity, starting with the banking company. So a banking company is the one that has been defined under the Banking Regulation Act. Then coming to the financial institutions, that would include your NBFC, your insurance companies, a payment system operator for that matter, your Department of Post for that matter. Now, a chit fund company and a house financial finance institution is also included. An authorized person under FEMA to deal with the foreign securities and you say foreign security in terms of FEMA. So that is what is included under the purview of financial institution broadly. Coming to intermediaries, whosoever has been registered under Section 12 of the SEBI Act. So those comes within the expression intermediary. You can have an association also, or any member of the association which has been recognized or say registered under the FCRA. Then you have intermediaries which are registered under the Pension Fund Regulatory and Development Authority, and also a recognized stock exchange, which is obviously recognized by the SEBI, by the Security Contract Regulations Act. Then all the notifications that have come, which have expanded the span and the ambit of the expression reporting entity, has been the thrust thereof has been on the expression a person who carries on a designated business or profession. So last year, the notifications that have come from the central government that has widened the purview, has encapsulated a lot of professionals by classifying them as a person carrying on a designated business or profession. So in that you have your a person who's carrying on activities for playing games of chance for cash or kind, including casino. So far as casino is concerned, now there has been a lot of queries that even we have received, that whether a casino would be falling purely as a game of chance or a game of skill. So taking you to the public the prohibition of the Gambling Act that we have in India, 1897, if I'm not wrong, that specifically restricts and prohibits the gambling and betting in India. Now, so far as casinos are concerned, there are you can say there are plethora of Supreme Court judgments on this point that would say that if a game is purely a game of chance, in that case it is illegal. But if a game has some element of skill, in that case it would not be purely illegal. If I draw your attention to two very important Supreme Court judgments, that is one emanated from Maharashtra, that is state of Bombay versus RMS Chamar Bogla, and one is state of Andhra Pradesh versus K Satyanarayana. These two are very important judgments. Insofar as you say the subject matter was for rummy and the other game, that is your say triple teen patti flush. This is how the expression is. So far as teen patti flush was concerned, the Supreme Court categorically said that it is purely a game of chance, because it would depend upon the luck and the chance on the set of the card that you get. But so far as rummy is concerned, because rummy would entail some skill on how you place them. So rummy was classified as not a pure game of chance, rather a game of skill, because that entails some amount of skill and effort as well. So far as casinos are concerned, yes, casinos would be a reporting entity, because casino is not purely a game of chance, that would entail some amount of skill. Also, when this question pops up, so we apparently don't have a federal law on this, but then there are some state laws. If we say Assam, Nagaland, Odisha, they have their own state laws, governing this subject. In Punjab, we have state lotteries, which though would be a game of chance purely, but still that is permissible. So far as this subject is concerned, it is still being governed by the Supreme Court judicial pronouncements and the state laws that we have in force. Next is the Inspector General of the Registration, appointed under Section 3 of the Registration Act. This is so far as the properties are concerned, because the value of the property, the sale purchase thereof, whenever it will exceed rupees 50 lakh, that will become a transaction which is supposed to be reported by a reporting entity. So in that case, it is the Inspector General of the Registration who is supposed to report it. I'll take you to those obligations in the upcoming slides. Then we have a real estate agent. So a real estate agent, dealer or broker, or by whatever nomenclature is being used, right? So that is also within the ambit of real estate agent. and would qualify to be a reporting entity. The only thing is that there are certain threshold limits that his annual turnover doesn't exceed 20, should exceed, sorry, 20 lakh. In that case, he's a reporting entity. And the transactions that he's supposed to report to the FIU India, that is the Financial Intelligence Unit India, that has to be say above 50,000 rupees. So that is, there are certain thresholds when it comes to what is to be reported and by whom it is to be reported. Then dealer in precious metals, precious stones, and other high value goods. Same, there are certain thresholds also. There are, if there is a cash transaction exceeding 10 lakh, it is only in that case that the dealer in precious metal, precious stones, or any other high value goods would qualify to be a reporting entity, and that transaction is meant to be reported. Then person engaged in safekeeping and administration of cash and liquid securities on behalf of other person, and person carrying on such other activities that the central government may by notification so designate them. So the notifications that have been there, that have been that have come in the past few years, so those notifications have expanded the horizon by inculcating and including different entities, different set of professionals or entities under the purview of the expression a person carrying on designated business or profession. So accordingly, they qualify to be a reporting entity. This is just a pictorial representation of what I've just told you. Additionally, we recommend, the due diligence, that is one of the most important obligation that has been casted upon a reporting entity in M&A and cross-border transactions, strategic investments and joint ventures, asset or business acquisitions, and businesses which are exposed to financial fraud or high risks. Next, what are the important notifications that have come with respect to the reporting entities thus far? So the enabling provision is section 2, subsection 1, clause SA and subclause 6 thereof. The central government has notified in the past couple of years all these reporting entities that you can see, starting from a multi-state cooperative society, which again has been designated as a person carrying on a designated profession, business or profession, which is the fourth category of the reporting entity. A real estate agent, as I explained you earlier. So is the case for dealer of precious metals and precious stones. A business relating to virtual digital assets. So all the VDAs that have also been brought within the ambit. Financial transactions carried out by a practicing CA, CS, or CMA, that was done in 2023. And then trust and company service provider services also. So that would include, which are being carried out by these professional CA, CS, or CMA. So that would include, when you provide, when you provide the pre-incorporation service, providing registered office address and everything, you provide a director for the incorporation purpose as well. So that entirely has been brought within the ambit of the reporting entity. And accordingly, why reporting is important and why this legal regime for a reporting entity and the obligations that have been casted thereupon, the statutory mandate is in compliance with the FATF norms to combat with the offense of the money laundering and to preempt and also to predict and to detect the offenses pertaining to the money laundering. So this is where exactly the role of the director FIU India comes into picture. So it is by way of reporting and ensuring that there is compliance of the reporting obligations, the statutory reporting obligations, that the statutory mandate of the PMLA is being given effect. Now, coming to what are those situations when you can say the reporting entities actually get into trouble? So, in case a reporting entity onboards a client and there is incomplete or inadequate KYC, or there are say non-genuine documents which have not been verified by an eKYC, in that situation, these are certain illustrations that we apparently come up with. These are some litigations that we are handling, some of the investigations that I've seen from the departmental perspective, some from the defense perspective that I'm doing as of now. So I thought of, clubbing it up and, giving you a comprehensive and a 360-degree kind of a view. So these were some of the important ones that I thought of culling out and explaining in this session. So the first one, say there was apparently an entity, an account opened for a shell company, the entity that I'm referring to, with a fake address proof, which rotated say over 40 crores within 2 months. So the siphoning is to that amount. The amount was basically a loan amount. It was a loan that has been sanctioned by a consortium. The loan was significantly high. So 40 crore is just one quantum of the loan that got siphoned off using a shell company. So the onus comes upon the bank that the bank has actually failed. Bank being banking company being a reporting entity has failed to do the KYC, do the necessary KYC. So that is one such instances where the banking say company or the banking institutions gets into trouble being a reporting entity. Then the second one says high value cash activity not matched with the customer profile. That apparently happened in one of the cases. It's basically a money laundering case. The predicate offense, actually, if you see, it's a sand mining offense. Sand mining, though, generally doesn't come within the scheduled offenses. But the FIRs therein, they generally incorporate section 420, 120B, and necessarily, making a good case for the ED to investigate because 120, 420 of the erstwhile IPC, at times there are forgery also that is invoked. So that makes a good predicate offense for the ED to investigate under PMLA. Now, in one of those cases, what we saw that a laborer account saw rupees 30 lakh cash deposit weekly, and that is something that doesn't matches with the customer profile. So that is again a dereliction of the duty, or you can say a dereliction in the statutory obligation in the compliance there. Then allowing frequent inward remittances to low income individuals, again a similar kind of an example wherein students, housewives, laborers, these were basically mule accounts which were opened using forged KYC documents, which actually pertains to some students or say housewives or laborers. And these accounts, these mule accounts, which were used solely for the purpose of siphoning of the money. Then misuse of the LRS, that's a recent one that we apparently are dealing with. So there are certain funds which have been sent outside India using the LRS scheme under the for, and also the stated purposes for the education and the fees of the overseas education, but that amount was actually being used for crypto trading. So that is one where the reporting entity through whom the amount has been remitted, that's get into trouble. Then NPO trust society accounts with no monitoring at all. This is something that we examined, I think 2 or 3 years back. A trust account was used for rupees 6 crore inward donations, which was ultimately linked to a foreign funding. And ultimately that invited FEMA implications as well. And the case, I think so, because this is some departmental example. The case apparently has landed up in PMLA proceedings as well. Then ignoring red flags in fintech partnership agreements, a fintech company which opened 15,000 accounts with a weak KYC, and many were used for scams. So these are some very common and very, you say, very, very special examples through which, the proceeds of crime, they have been siphoned off, they have been, integrated into the main financial stream. And accordingly, because the reporting entities were not say compliant with the reporting obligations, they did not report such like transactions timely or have failed altogether to report it at any given point in time. So that brings them a lot of trouble. Coming to next slide, that talks of statutory obligations. Now the statutory obligations are primarily under four heads. First is the client due diligence that we call CDD. Then is the EDD, that is the enhanced due diligence. Enhanced due diligence is in the case of high risk customers. Then there is monitoring of transactions that are being carried out. And lastly is the maintenance of records. CDD, that is the client due diligence, that is the basic verification. You can say the background verification, identity, address, nature of business, the income proof, profile, etc. Updated KYC that must be maintained periodically by a reporting entity when it onboards a client. Then when it is onboarding a client, which apparently is a high risk client. So high risk client would be your PEPs, your politically exposed persons. If you have some reason to believe that the entity apparently is a shell entity, in such like cases where you see wherever you can see or you can raise a red flag, in that case the EDD is essential, because for in the EDD case, in the enhanced due diligence, it is important for the reporting entity to at the time of onboarding of the client that it should verify some additional there are some additional checks that have been provided. It is supposed to see the ultimate beneficial ownership as well. If there is a transaction which is to be given effect to, the source of the fund is also to be checked. or an attempt is to be made to check whether the source of the fund is related to some untainted money or not, whether it's clean money or not. And then comes the senior management approval, that in case you want to onboard the high risk customer despite seeing all the red flags, then obviously your senior management approval has to be there. There has to be some reason, that has to be cogent reason for onboarding the client. Then monitoring of the transaction. It is imperative for all the reporting entities to have an automated AML system, and which is and manual reviews must continuously analyze patterns to detect suspicious or unusual behavior. So unusual, or you can say the suspicious behavior, pertains to a suspicious transaction wherein you can say now the question would arise, what would be a suspicious transaction? A suspicious transaction would be where it is appearing a little unusual, which is not matching with the, you can say, the profile of your customer, the profile of the entity, or the profile of the individual in that case. And you, as a reporting entity, would have sufficient reason to have this impression that there is some, I mean, there's something fishy, there's something shady. In that case, the monitoring is also required. And if you suspect that kind of suspicious transaction, irrespective of whether it has been given effect to or not, or whether it was only an attempt to give effect to that transaction, that requires the reporting thereof requires within a period of 7 days from the date on which the transaction was attempted or carried on successfully. The transaction, the STR, is to be generated and is to be reported to the director FIU. Then lastly comes broadly the maintenance of record. Maintenance of record is generally for a period of 5 years. So all the KYC documents, the account opening form, STR justifications, transactional data, everything is to be preserved by a reporting entity for a period of 5 years minimum. Then coming to FIU India reporting obligations. When it comes to reporting, like I told you about the STR is supposed to be detected and accordingly reported consequentially within a period of 7 days from the date of its detection. There is no threshold that has been provided in the Act or in the rules in the PML Maintenance of Record Rules 2005, which gives any kind of threshold that it is over and above this amount that the STR is to be reported. So for a suspicious transaction, the amount is irrelevant altogether. Then cash transaction report, when the transaction has been carried out purely in cash, then it is 10 lakh individually or through multiple in transaction. Multiple in transactions means, say, in a combined span of 1 month, if the individual transactions, though they are less than 10 lakh, when put together, when clubbed together, and the period being 1 month, the threshold would qualify 10 lakh or above, then it is a cash transaction report and it is to be submitted monthly. Then in the case of cross-border wire transfer, the threshold is rupees 5 lakh. 5 lakh in the Indian INR, in the Indian currency, or its foreign currency equivalent, if the either the source is in India or the destination is India. That way it is to be interpreted. Then the NTRs, that is non-profit organization transaction. In this case, also the threshold is 10 lakh for transaction involving NGOs and NPOs. And counterfeit currency reports when the counterfeit currency is detected. So in the counterfeit currency report, there is no as such no threshold. The amount can be anything. But if there is a counterfeit currency, then it has to be reported within a period of 7 days. That being another, you say, STR when you have generated. And obviously, failure to report would invite penalties under Section 13 of the PMLA Act. The director FIU is empowered to impose penalty. Now, coming to EDD, that is the second category. If you could recall, I'll take you back to that slide wherein I have categorized and classified the obligations under 4 heads. The second one that I'm talking to, that is the EDD. Now, this basically pertains to EDD, for whom EDD is mandatory. I was giving you an example of politically exposed persons, your non-profit organizations, cross-border transactions, shell company. Now, how do you detect a shell company? So that is where, I mean, a reasonable question would be how a reporting entity sitting in an office can detect that, or can preempt or can apprehend that the company or the customer that has come to it for onboarding is a shell company or not. For that, EDD is required. You got to check on I mean, on ground investigation is quite relevant here and is necessary. to detect, whether the company is sharing the common address, what is the status, what with respect to the compliance, the corporate secretarial compliance, whether they've been compliant, whether they've been filing, what is the data on the MCA. So all these are required to be taken into consideration while doing the EDD. Cash intensive businesses, crypto related, that is highly susceptible and vulnerable. MSME showing abnormal turnovers, fintech digital business accounts. Also, I would say what I've not included here in is, but which is very important, is the gift city SEZs. Gift city SEZ is altogether a foreign, you can say it obviously like an SEZ, it is altogether a foreign territory. Now, the vulnerability of the clients that are dealing with the entities that are sitting in the gift city SEZ is very high. So Gift City SEZ, which has been established in India, and primarily the motive is to deal with the Indian clients only. That is the rationale behind setting up of a Gift City SEZ. Now, the vulnerability of the Indian clients, that is where the education and the kind of awareness programs that are required for the Indian clients, that they are highly susceptible and vulnerable while they deal with the Gift City entities in the Gift City SEZs. Since it generally happens wherever cross border implications arises, the you say the governance on the enforcement of law, it becomes a little weak, not weak, but it becomes a little difficult to give effect to law at times in the cross border jurisdictional issues. So it is there also that any client, any person that is dealing with any of the entities that is in the Gift City SEZ, so that way it is important for for that entity also to get the EDD of the other entity done, just to mitigate the risk and eliminate the chances of landing up in another problem. There are certain case studies on the EDD that I felt like discussing. So far as cross border transactions are concerned, an MSME with no export history, suddenly received this 250 US dollars from a UAE entity as an export payment. When we conducted EDD, because in AKM we also provide the AML integrated due diligence service. So these are some examples that apparently came up in our service line. So while we were doing the EDD, what we revealed that this entity, this basic this MSME that was in India, it revealed that there's no infrastructure, no setup at the place where the location was assigned. There are no employees, no shipping bills, and ultimately what we found that these transactions were linked to a hawala network, and accordingly the EDD in this case saved the person, the client, the entity that was about to deal with the MSME. Then is a non-profit organization example. Trust received a large foreign contribution from unknown donors abroad. The EDD found that the trust had no staff at all. There were no charity operations that were going on, and a very few local expenses. I was just being set up as nothing but a kind of a shell kind of an entity just for the purpose of receiving funds and getting it mobilized for the political funding and everything. So the case then got escalated to the FIU India. Then cash intensive intensive businesses. We found that there was a restaurant that was declaring the monthly turnover to be 15 lakh, but accordingly we was depositing only 90 lakh every month. When we conducted the EDD site visit, the physical capacity and when it was matched and corroborated with the customer footfall, we couldn't find for the support for the turnover that it was declaring. And accordingly, funds were later on traced to an unaccounted income from illegal liquor distribution. Accordingly, the transaction was stopped. Our client was saved from not dealing with that the owner that was running that restaurant. Shell companies. Our EDD revealed that there are 14 companies that were registered at one point in time at one residential address that shared the same director and accountant. No real business were formed. When we did the physical on ground verification, these entities were ultimately using the funds, and the circular trading was going on just to inflate the turnover and to launder the proceeds. If I'm not wrong, I think this apparently got linked ultimately to a money laundering scam, wherein the I think some this multi-level marketing scheme was being used. So it was some MLM. The FIRs apparently pertained to Hyderabad, and then the it was ultimately found. I mean, we got to know ultimately that the amount of the proceeds of crime that have been generated through those multi-level marketing MLM schemes. The FIR therein was registered in Hyderabad and Telangana. Ultimately, the funds were being used by these entities for the purpose of integration in the mainstream. Then there are certain MSMEs that showed abnormal turnover. There was a small trading firm with a 40 lakh annual turnover, and suddenly it reported an 8 crore transactions in transaction over 2 months. When the income verification was done through EDD, it showed GST invoices, fake GST invoices, and round tripping among the related entities, because it was an attempted one, an attempted transaction. So we apparently generated an STR immediately. The risk or the penalties that are being faced by reporting entities due to non-compliance. Broadly, there are three kind of risk. If you see, there is a regulatory risk, there is a reputational risk, there is an operational risk, and I'll explain each one of them with relevant examples. So far as the regulatory risk is concerned, obviously Section 13 empowers the Director FIU India in that context to impose a penalty that ranges from 10,000 to 1 lakh per violation. Coming to the reputational risk. Now, reputational risk, any lapse in the ML compliance uh, and say would bring you would deter the others to have some kind of transaction with you. There are association with accounts connected to fraud, extortion, illegal betting, or say proceeds of crime that can lead to media scrutiny and reputational erosion. So ultimately that affects your business. So that is one thing that has to be kept in mind, that reporting obligations, they have serious repercussions. The non-compliance one can face just by getting a penalty imposed, but the reputational risk that it entails and incurs, that is one damage that I think that is irreparable for some entity. Coming to the operational risk, now this apparently has come up in a litigation issue that we are currently also dealing with. Now, what apparently has happened, it is an entity, it's a fintech company, but that fintech company is not a reporting entity. Now, one would say if it's a fintech company, either it has to be, classified, as a banking company or in the financial institution category that we discussed earlier at the very outset of the, broad definition, broad classification of the reporting entity. But this is one classic example wherein the fintech company that we are dealing with, it doesn't fall within the definition of reporting entity per se. It is basically a business correspondent to a payments bank. Now, the payments bank has got a license from the RBI, so is the business correspondent. Now, the business correspondent apparently is running on a B2B model. It apparently is engaging the dealers or the agents by whatever nomenclature or whatever name they call it by, or whatever nomenclature they use. So, what these dealers and agents are doing, so far as the agents and dealers that have been taken on board, they do the KYC. Although it is not a reporting entity, the business correspondent not being a reporting entity, it's still doing the KYC of the agents and the dealers. Now, what happens is that these, because it runs on a B2B model, so it is providing its platform for the remittance of payment from one end to the other end, from say payer to the pay, or from the payer to the beneficiary. But the point is that the KYC is done only of the agents and only that of the dealers. What I mean, you can use the term interchangeably. They are not doing the KYC of the beneficiary or the KYC of the one who's paying the money. Now, this business model, the risk that it entails, because if you remember in the previous slides, I've specifically used an expression that there are certain businesses, there are certain fintechs that runs that risk, or that risk that is associated with the financial dealings or the financial transactions. This is one such ideal example. Now, apparently, the allegation is that somebody got cheated in some foreign jurisdiction. It is a case that emanated in USA. So there is a US citizen that got cheated by way of some online fraud. The amount got, there's some bank account that was used, and the amount of that US citizen, some huge amount was deducted from it, and apparently that siphoned off in India, that came to India, that was routed to India using the platform of this fintech that I'm referring to. Now, the stand of the fintech is, in this case, that I'm not a reporting entity. So far as the RBI circular, which recognizes the business correspondent, So far as the legal regime, existing legal regime is concerned, RBI only requires that the KYC of the agent or the dealer is supposed to be done. That they've already done. So they said that we were fully compliant so far as the existing norms are concerned. They say that we are not a reporting entity. It provides its platform. It says at best I'm a technological, you can say intermediary to be specific, because it's providing its platform. Now apparently what happens when the amount gets siphoned and routed through the platform of the business correspondent, the enforcement directorate in a PMLA proceeding seizes certain documents, that is in the search proceeding. And the bigger damage, or you can say the bigger harm that has been done, is that the bank accounts, the current accounts of the business correspondent stood freezed. The amount lying on the date of freezing ran into CRs. The amount of, you can say, the amount of money that is in question in US, the amount which has been duped from a US citizen, would run into some lakhs when converted into the Indian currency. So PML proceedings are so draconian that the allegation of the department, on the thrust of which the search proceedings were conducted and a consequential freezing of the accounts was done, the department came up with the argument and the allegation that since your platform was used and you have not done the adequate KYC of the remitter, neither of the beneficiary, it is your platform that is being used. This platform looks so shady that it is only the KYC of your agents that is on record, and you have not complied with the reporting obligations. The argument in defense was that since this entity, which is a business correspondent, does not fall in either of the four categories of the reporting entities that has been classified under the PMLA Act, it is neither a banking company, nor it is a financial institution, neither it is a person which is designated or carrying on designated business or profession. So we said that in such a situation, you cannot say that there is a dereliction on our part where we failed to comply with the reporting obligations or the reporting norms. Apparently, what has happened? We were in a position to get the accounts defreezed, subject to a minimum lien in favor of the enforcement directorate to the extent of the amount that is in question, or the amount that has been routed, that is running into some lakhs. And we got the current accounts defreeze to that extent. Now the important implication is that even if you don't qualify to be a reporting entity, but the business that you are into and the financial transactions that you are into is such that yields that, and that makes you so vulnerable with all these kind of scams that can be conducted. So in such a situation, despite not being a reporting entity, still, if you don't develop a robust mechanism for AML compliance within the organization, you can land up in such a problem. Now, even if I have to deliberate further on this issue, what exactly can happen with such a business correspondent which will not qualify to be a reporting entity? Because it's a very good defense for a business correspondent to say that, see, as per the RBI regime, that RBI circular that is in picture, we have done what was required. So whatever legal mandate was there, we have done. We have conducted the KYC of our dealers or the agents, whatever name or nomenclature you may use. But it was not required at that point in time that the remitters KYC is also to be done, or the beneficiaries KYC is to be done. It is only after 1st of November 2024 that the RBI has come up with another subsequent circular which mandates that the KYC of the beneficiary is now required. So this apparently is an aftermath of this case that we are currently dealing with. And in this case, I tell you, the nuance is that if I see the business model of the business correspondent in question, you cannot attribute knowledge of the proceeds of crime being rooted or being used, or being layered and being transmitted or being remitted using your platform, because ultimately you don't have the knowledge as to who's the remitter, neither you have a record as to who's the beneficiary. It is only the agents that you have taken on board, you have the KYC thereof. So but One good thing that this entity did in this entire case is that though it was not a reporting entity, but when it detected that there are certain agents that it had onboarded are dealing with, extremely high amount of money on a daily basis, they did report it to the jurisdictional police. Because obviously when you are not a reporting entity, by no means you can, you know use the finnet platform, finnet 2.1 2.0 portal that is devised by the financial intelligence unit. So by no means you can report the or you can report the suspicious transactions to the director FIU India, but at least you can come up with a robust mechanism for detection thereof that will ultimately show your bona fide, and that will be against the case that has been mounted by the department against you, wherein the department intends to attribute knowledge also. So the intention of the law enforcement agency in this case is that you apparently conspired with the scamsters that were there in India who have duped one US citizen, and your platform, your platform that you have created, that has been used for the purpose of remittance of that money from to several beneficiaries which are located in India, and you don't have any details, any KYC details of the remitter as also of the beneficiary, ultimate beneficiary to whom the amount has been paid. So, but still, what holds good in this case is that it apparently had a robust kind of a mechanism, some AML compliance training programs that it devised during the course of its operations, that which were duly imparted to all the, you can say, agents from time to time, and also to the other employees of the company. And accordingly it enabled them to detect the STR, which obviously they couldn't report, but they couldn't report it to the FIU India, but they apparently took the help of the local police. At least they reported it to the local police and got an FIR registered. So that is one thing. So I think this example, with so far as the operational risk is concerned, this is something that has come up from one of the cases that we are dealing with right now, and I thought of sharing it because the more insights that I share, I think that would help you understand the nuances of the implications that are attached with non-compliance of the reporting obligations. As I was talking about the AML integrated due diligence, so AML integrated due diligence shall always combine the CDD, EDD, sanction screening, adverse media reporting, and the beneficial ownership identification as one of the unified process. AML integrated due diligence should also use automated KYC and risk scoring. These are all, you can say, parameters with which the risk which is associated with a high risk individual can be mitigated. The AML integrated due diligence will also include real time transaction monitoring with rule based and behavioral alerts. It identifies beneficial ownership across various corporate layers, and even for that matter in different jurisdictions as well, different countries as well. It enables ongoing monitoring for changes in the customer risk profile. It helps detect high risk activities like round tripping, layering, using of mule accounts, crypto abuse, misuse. So that way, which is something which is a very common modus operandi when it comes to integration of the untainted money into the mainstream. Then it should also provide for a faster suspicious transaction report identification and filing thereof. And the AML integrated due diligence also reduces regulatory penalties and strengthens overall compliance. When it strengthens the overall compliance, it helps you mitigate reputational risk, it helps you mitigate operational risk, it helps you mitigate every kind of other risk that is associated with your business. We've also come up with one illustration, a fintech which detected 35 crores rotating between multiple accounts within 48 hours. Automated monitoring flagged round tripping patterns, linked directors, and rapid fund movement. Behavior was inconsistent with the customer profiles, which triggered the STR. FIU investigation, when initiated, it revealed a larger laundering network using fintech accounts. So, because of the proactive detection in the STR filing, no penalty was imposed upon the reporting entity. So, this demonstrates how effective AML integrated due diligence is. In the current in the current regime for preventing any kind of we use a penalty that can be imposed. Likewise, coming to the entities which are advised to follow FIU norms, even they are not reporting entities. One example that I have given you that pertains to a business correspondent. There are other models also which are linked to a business correspondent. That is, if you see the fourth one, two, three, four, the fifth pointer, wherein I say entities who are not business correspondent for various payments banks. So this I've already explained, given this was one of my cases. Then API partners for business correspondent. This is the second category. And third category is channel partners for API partners for business correspondent. They all are at high risk because, as I said, for the business correspondent, the business correspondent is one that is providing its own platform, which has come up with its own platform. Now, when I say, why it is necessary, if you take the example of PayPal, now PayPal is a very good example if I have to demonstrate here, though I have not included the citation and not included the case law, but since we are dealing with the such like entities which apparently uh, stated or apparently believed that they do not come within the purview of a reporting entity, but ultimately through a judicial pronouncement it was held that they would have to comply with the obligations envisaged in the PMLA with respect to reporting to FIU. Why I say PayPal is an ideal example. So basically PayPal was also it was providing the you can say it's a technology intermediary. This was the case of the PayPal. Now, PayPal said that as far as the payment system operator, the definition thereof is concerned, I do not qualify to be a payment system operator. Now, if you remember in the four broad categories that we discussed with respect to the reporting entity, if you remember the second category, that is the financial companies, wherein we see the financial institutions I explained to you. So in that, it also includes a payment system operator. Now, payment system operator is an expression that has been defined under PMLA as a payment system operator, which has been defined under the Payments and Settlement Act. If you see Payments and Settlement Act, a payment system operator would be one who is who uses a payment system. Now, what is a payment system? A payment system would be a system which is used for clearance of the payment from the payer to the ultimate pay or the beneficiary. It would also include your credit card operations, debit card operations, etc. Now the case of PayPal was that I do not qualify to be a payment system operator, and as such I do not qualify to be a financial institution. Accordingly, as a consequence thereof, I do not qualify to be a reporting entity. Now this is the case that was put up by PayPal when a fine of I think 96 lakh was imposed by the director FIU India for non-compliance, for non-registration on the FinNet portal, and for the non-compliance of the reporting obligations subsequent thereto. So PayPal came up with the argument that, see, my role is in an export transaction, my role is only confined to providing a technological interface. So I'm nothing but a technological intermediary. It said that when it comes to an export transaction, so when the exporter is in India, the buyer is overseas, it says that my role is only confined to making or processing that payment so that ultimately it reaches to the Indian payee, the Indian exporter. But the you say the onboarding, or you can say the enrolling of the overseas buyer or the payer which is in the other country is not of mine, is that of you can say of the schedule one commercial bank, or you can simply say the authorized dealer bank. So far as that is concerned, this argument was turned down by the Delhi High Court, and the Delhi High Court said that if you see the intent of PMLA and the Payment and Settlements Act is altogether different. So even if you don't qualify to be a payment system operator as per the definition that has been envisaged in the Payment and the Settlements Act, still you would qualify to be a payment system operator as per the definition that has been given under the PML. So given the you can say the statutory mandate or the legislative intent with which the PML Act has come into force to combat the menace of the offense of money laundering, it was held that despite this argument of yours that I'm only a technological interface provider, and the argument also stretched to the length that the PayPal also stated that I'm nothing but an online gateway payment service provider. This is what I am and nothing more than that. So how can I be a payment system operator per se? But this argument was turned down, and accordingly, it was held that you would qualify to be a payment system operator under the PML Act, even if you don't qualify to be a payment system operator as per the definition given in the Payments and Settlements Act. So that is one classic case where an entity which would classify itself as a non-reporting entity, but still ultimately given the norms, or you can say given the magnitude and given the intent and the legislative mandate which PMLA holds, and the menace of the offense of money laundering that is involved, it would still qualify to be a reporting entity. So that is one case where it was qualified to be a reporting entity by way of judicial pronouncements, or you can say the wisdom, or you can say the opinion that the director FIU had while imposing say penalty upon PayPal, which accordingly was upheld by the Delhi High Court. So it got that judicial sanctity from the Delhi High Court's judgment. Now, coming to the case that I am trying to, explain, the case of the business correspondents. So today, the business correspondents apparently have a good defense to say that we do not fall within the definition. We do not qualify to be an intermediary. We do not qualify to be a financial company or financial institution. Sorry, we do not qualify to be a banking company, and accordingly, the obligations that have been envisaged by the PML Act do not it's not mandatory for us to comply with those obligations. But there have been instances such like a PayPal case, the one that I'm dealing, that is a business correspondent case, though it has not reached that extent. There is still it is at a nascent stage, so it has not dealt at a stage where some kind of a authoritative judgment is awaited, and we have put this into picture that it is akin to PayPal, and the same judgment would apply in our case also. Second is an API partner for a business correspondent. Now, API partner for business correspondent is one which does not has its own platform, which does not provide its own online platform. So API partner would be a small fintech company which will enter into a service provider agreement with a business correspondent. So basically, what an API partner is doing, API partner is being a small fintech company which cannot, obtain the license from the RBI, that of a business correspondent. So it will enter into an agreement with the and that will be termed as a service provider agreement. So API partner would enter into a service provider agreement with the business correspondent, wherein it will use the platform of the business correspondent. And the question would be like, why a business correspondent would what's the benefit that you can see in terms of a business correspondent entering into such like service provider agreement? Because by way of that also, the business correspondent is able to generate commission per transaction. So that will obviously an additional revenue that the business correspondent could generate. And more so in the light of the fact that the National Payment Corporation of India, it also recognizes such like agreements. So an API partner being a very small fintech company bereft of a license from the RBI and is using the platform of business correspondent and doing identical things. So when the stand of the business correspondent from today's legal perspective is that it is not a reporting entity, so applies for an API partner as well. So we advise that such API partners, which is nothing but a small fintech company, that should also come up with some robust, AML compliance mechanism, so that at any given point in time, the risk that they are incurring with every financial transaction, as and when that gets into investigation, at least they are able to mount some strong defense and able to safeguard themselves from the penalty or from the criminal prosecution that may start under PMLA. Third category, you add another entity that is by the name of channel partner. So channel partner for API partner for business correspondent. This is another business model. Now, this is basically a tripartite agreement with a business correspondent and an API partner and a channel partner. So channel partner and an API partner. So basically in this transaction, the API partner would fetch some commission, and obviously the business correspondent, because it is lending its platform to be used for the financial transaction, for the remittance of funds. through its platform. So obviously the business correspondent is definitely going to generate some commission out of it and is going to generate revenue out of it. All three of them, including the business correspondent, the API partner, as also the channel partner for the API partner, all three not being a reporting entity, we strongly suggest them that they should comply with the FIU norms to the extent that, as far as reporting of the STR is concerned, though they directly cannot report it to the FIU India, but in case there is some suspicion, they should report it to the local law enforcement agencies. As also maintenance of record, because the minimum time period, the stipulated time period is 5 years. I would say you keep it for a longer period, because if you take this defense that nothing is available with us at the point in time when the investigation starts, then you might land up in a problem. So, and what exactly, what more can be done to mitigate the risk which is associated with the kind of business the business correspondent, the API partner, and the channel partner for the API partner is running? So to mitigate that risk, what they can do, they can, this is our suggestion, that they can implement a gray PAN card list also, wherein a list of the PAN cards can be PAN cards suspected to be used in the fraudulent transaction shall be shared with all the stakeholders in the digital ecosystem, and any transactions conducted using said PAN cards can be blocked. So this is one, and on also a robust mechanism. And I would say educating and creating more awareness in terms of the dealers that these business correspondents or the API partners or the channel partners for the API partners have taken on board. More robust, you can say, training programs can be implemented to educate them and for the detection of the STRs, and for the purpose of being FIU compliant. I would not say that directly report, because that is not a possibility. You cannot register on the FinNet portal without being a reporting entity per se, because obviously that would require a designated director, a principal officer, a reporting officer, whatever interchangeably you call it. So until and unless you have that, you cannot register on the FinNet portal. So obviously you can't directly report to the FIU India, but it is always better to have some kind of defense created if you have that bona fide, if you are conducting a bona fide business and you don't want to land up in that reputational risk which is associated as and when the proceedings and the investigation starts. Then
So,
coming to the recent, yes, yes,
so we do have a question in the Q&A box.
yeah,
It is regarding the CA firms, and there are follow-up questions. Is it fine if I
yeah,
ask them right
yeah,
away?
yeah. Please, please, we can take those
Yes.
questions.
The question is from Tejaswini R. So
Right.
the question is, what is the procedure to register under PMLA as a CA firm? Then there is a follow-up
I'll I'll
question.
I'll answer this. I'll answer
Yes.
this first. So far under PMLA, there is no specific procedure for the registration. It is basically, I think, what Tejaswini is asking is the registration of a reporting entity. I mean, CA firm being a reporting entity with the FIU portal, the Financial Intelligence Unit India, that is providing a platform, a portal that is by the name of FinNet portal. FinNet 2.0 is the portal. So accordingly, there you have to register that portal. That this is what I was just specifying, Abhi, in the last slide. That for the registration you would need a designated director. For that you would also need a reporting officer or a principal officer for the purpose of as to who exactly is going to report. So that is Tejaswini. That is there is a procedure that has been prescribed. If you see the FinNet portal, there is all the mandatory details are required to be filled in. Accordingly, you can get yourself registered on the FinNet portal, because the act apparently would not give you the registration process. It is something that has been done in exercise of the powers that are there in the rules by the FIU India. Can
Yes.
we take up the next question?
Yeah, it was in connection with this. Like, when it is applicable for CA firms to register under the PMLA,
Oh,
it says
when it is can you repeat? I'm not getting it. When it is mandatory for them to register.
when it is applicable for CA firms to register under PMLA Act, and it says
Okay.
that CA firms need to register with ICAI and then PMLA, something like this. It is there. So can you
ICAI
clarify the same?
ICAI would be, see, that would be your regulator. That is all right. That is the regulator. That is the professional regulator. But so far as, since CA firms, CA, CMA, they have been classified as a reporting entity. by virtue of the notification that came in the year 2023, which said that these would fall under the definition of person carrying on designated business and profession. So that is where the compliance comes into picture. That is where you once you've been designated as a reporting entity, you got to register yourself with the FIO India. You got to comply all the norms, all the obligations that are there under all the statutory obligations that have been envisaged under Section 11 of the Act, Section 11A, Section 12, Section 12 AA. So that is where this entire process has started since the coming into force of that notification.
Yes. Next question was what type of returns are required to file if we register PMLA? Like GST, we have to file nil returns in PMLA, or we can skip that return filing if there are no applicable transactions.
No, I tell you. So what has to be done, if you see what I was explaining in the earlier slides also, that if there are certain, say, cash transactions, the threshold has been prescribed. If you come across any suspicious transaction, there is no monetary limit that has been prescribed. So far as these kinds of transactions are concerned, there are different timelines now. So certain monthly, so there are quarterly reports as well, which goes to the FIO India. Quarterly report goes on every 15th day of the month succeeding the quarter in which the quarterly report is to go. But when it comes to the suspicious transaction reporting, it has to be done within a period of 7 days from the date on which you have detected. So, as such, whether a particular return would qualify to be, submitted as an STR would be dependent whether it is an STR or not. That is one thing. I
Uh,
hope that gives clarity.
yes. So the next question is from Akshat Goyal.
How is
How
it applicable to the corporates who do not have financial business, however, investments abroad? I would say this question apparently they are having investments abroad. So I would say investment abroad can say if it is in terms of the ODI. If there's a very classic example that I would give. Why is it necessary? Why ED, for example, in such like case is necessary? And I think that would fit into Akshat's case. So, Akshat, basically, we apparently were dealing with one of a client who was about to enter into some, manufacturing agreement with the manufacturing. It was some home appliances. I'm not able to recollect the appliance that was in question, but the Indian manufacturer was an Indian appliance manufacturer. So ultimately, when we were doing the I mean, when we were doing the AML integrated due diligence, what came up that the red flag that we raised that apparently the Indian manufacturer of the home appliance has apparently sent some remittances overseas. Now the nature of the remittance was an advance against the import, which import was never executed, and the amount was not even repatriated back to India. The overseas vendors were somewhere in I think in I think in China. And apparently, what happened that when this Indian manufacturer with whom our client was about to enter into a transaction, when we were doing this EDD thing, this AML integrated due diligence thing, what we also, brought to the limelight that the amount that went to China and it never returned to India, what kind of an eyewash was given to this transaction. They apparently conducted a Singapore arbitral, an arbitration in the Singapore Arbitral Tribunal. There was an arbitration agreement to that extent. The Indian manufacturer of that home appliance made a self-serving statement in the tribunal saying therein that the overseas vendor to whom I have, given that outward remittance under the nature of an import transaction, import advance, that has already been wound up. Now, when we did our diligence, what we found out, what we come up, what our I mean, you can say our diligence thing report revealed that that entity in China was never wound up. It was basically in it's like a step down subsidiary that was created. In such a situation, we that raised a red flag. That as in when some proceeding would start up, this is something, this one entity, this manufacturer is someone who's going to land up in some kind of proceeding in future. So with that conjectural advice, we suggested our client that it is now up to you whether you want to go ahead with the transaction or not. So in such, like, even if the corporates, even if the corporates, as what Akshat has put up, they are not into financial transaction and they are having some kind of investments outside, they've made some investment outside India, be it through ODI route, they're creating a subsidiary or a step down subsidiary for that matter. But the compliance of the I would say the reporting obligations and the AML integrated due diligence, it would be it would enable you to mitigate the risk. It would enable you to raise the red flag, the concerned red flag, and then it is subject to this likewise we advised our client whether or not to proceed. So we said it's purely conjectural, this is what our report reveals, now it is for you. So the opinion that, I mean, I would not even say it's an opinion, I would say that it's a conjectural finding that we have given based upon supportive and assertive and corroborative facts that had come into our due diligence report. I think that answers Akshat's query.
Yes, sir, and we have another question from Rahul Nagda. What is the role expected to be played by statutory auditor of holding company where funds are routed through multiple subsidiaries and statutory auditor of holding company does not have access to these subsidiary companies' accounts?
Statutory auditor, I would say they generally gave this. I mean, they obviously they have this disclaimer every time they put up a report that whatever report that they have given is based on whatever documents were supplied to them. So that qualified report that the statutory auditor should give should necessarily take into picture and should necessarily be comprehensive to that extent, so that the statutory auditor is in a position to uh, to show that that the level of independence that was expected of from a statutory auditor. We have seen certain cases wherein the statutory auditors have derelicted in their duty, and accordingly they got roped in as a co-conspirator, or you can say somebody who has knowingly assisted. So it is generally in bank fraud cases, I tell you. So in bank fraud cases, the ultimate utilization of the funds that have been obtained from the bank, when it is not being used for the purpose for which the amount has been sanctioned, and ultimately it gets diverted and siphoned off. So the role of the you would say the statutory auditor in giving the completion certificates or utilization certificates, that apparently that comes into picture, that is for the CA professional, so far as CA professionals are concerned. For statutory auditor, I would say the qualified report, the disclaimer therein saves the statutory auditor to show the bona fide and to show that there is no intention at all. Because intention and knowledge is something that is only inferable from the circumstances of the case. One might not get in an investigation any direct evidence. I tell you, so far as financial crimes are concerned, the beauty, or it's a very sarcastic word to be used, but the beauty of such crimes is, or you can say a distinctive pattern of such crimes is, that the only evidence that is served on platter is documents in a financial crime. Unlike any other ordinary crime, wherein you can have a murder weapon, or you can have the particular, you say, weapon or whatever that has been used for the commission of the offense. But in case of financial crimes, it is only the documents, that the documentary evidences hold the corroborative value, and the intention is something that has to be gauged through the circumstances. It serves both the prosecution as well, and from the defense perspective also. If the defense is able to create that doubt in the mind of the court that the intention that the department is trying to prove doesn't hold goods, by rendering cogent evidences, in that case, just like in the case of a statutory auditor, that disclaimer or that qualified report would definitely save him. That is my answer to that question. I think that brings clarity. If not, a supplementary question is welcome.
So next question is from Zeel Bangdiwala.
Yeah.
Is there any way to expedite the registration process of a company before IUND under the VDA category?
That apparently is something that I would say that would require a full-fledged session if we have to go into that, because registration, that is something that we specifically don't take into our consideration. That is not something that is within our zone. We don't do that. In so far as the litigation, white collar crime defense litigation is concerned, we don't do that. We don't do that. So that is something that I won't be able to answer. For that, you would require a professional who's into the pre-incorporation service. That apparently my vertical doesn't do that.
So we are done with the questions for now.
All right. So any more questions that are also welcomed? So let me just explain the recent trends that are covering the non-compliance. So far as the non-compliance is concerned, I've just culled out some of the important use in non-compliance orders that we have found. There is one by the Bywit FinTech, which is apparently a virtual digital asset service provider. The FIU India imposed rupees 9.27 crore penalty on Bywit for PMLA violations by order dated 31st of January 2025. The non-compliance is the non-registration with the FIU India portal, the breach in the AML record keeping rules under the PMLA, wherein you see the rule 7 would make it imperative that a record has to be maintained. Then Union Bank of India, which would obviously qualify to be a banking company as a reporting entity, there is a fine that to the tune of rupees 37 lakh that stood imposed for multiple PMLA violation under section 12 of the PMLA 2002. Now PMLA, sorry, read with rule 3, rule 7, rule 9 of the PML rules 2005. PML rules, actually these are PML, prevention of money laundering maintenance of record rules 2005, wide order dated 8th of April 2025. Also the other you say the non-compliance was to the tune of non-reporting of the STR, inadequate or weak KYC, and insufficient transaction monitoring. Then one is an intermediary, that is Bonanza Portfolio Limited, that classifies to be a reporting entity being under the head of intermediary. So there's another fine that has been imposed to the tune of 19 lakh 40,000. Coming to next one, there is an offshore crypto VDA service provider. The name apparently we couldn't find; it was not available. So there were notices that were served, and obviously it did not register on the FIU India, despite servicing Indian users. So non-registration on the FIU portal and subsequent non-compliance with the statutory obligations is one of the example. Then Earthstone Holding 2 Private Limited, it's an investment credit company. It falls within the financial institution, the second category being an NBFC. So similar is the case wherein deficiencies in terms of section 12(1)(a), 12(1)(b) that pertains to your customer due diligence, and the reporting entity was asked to ensure that is also the kind of the orders that will be passed under section 13. They will it's not just the penalty but also an advisory for future. They were asked to ensure that AML and CFT policy and procedure are implemented effectively. Then Paytm Payments Bank, this is one wherein a 5.49 CR penalty has been imposed for alleged money laundering related which is related to a gambling linked account wide order dated 1st of March 2024. Then Axis Bank Limited, purely a banking company, 1 crore 66 lakh 25,000 is the penalty that has been imposed. It was found that certain groups of individuals have defrauded unsuspecting individuals and firms through the offering of fraudulent tenders. The proceeds from these fraudulent activities were subsequently layered through other bank accounts, some of which were maintained in the Axis Bank. So, non-compliance of the reporting, non-compliance in terms of conducting the effective and the adequate CDD, including the KYC. Then Hong Kong and Shanghai Banking Corporation Limited, the failure is to carry out due diligence as required in terms of Rule 9, to implement effective mechanism to detect and report STRs, to report STRs and accounts of concerned entities in connection with four breaches found to have occurred, and to properly report, cross-border wire transfer reports. So these are some of the examples that we have come up. Lastly, why I've chosen to incorporate delisting of individuals and entities and defreezing of the assets under the United Nations Security Council Resolution 1718 and 2231. So far as 1718 is concerned, it still holds good. So far as 2231 is concerned, 2231 came in the year 2015. It was only valid for a period of 10 years. So on October 2025, it has ceased to exist. Now, what are these resolutions? So basically, these resolution, or if you can see what I've added, or successor resolution. So 2231 has gone, has it doesn't operate as on date, but 1718 is still operative. These are basically watch lists. So the watch list wherein an entity has been named and subsequent to and suffix used is India. That means it is associated with India or is an Indian entity. In that case, if you fall within that list, that watch list, in that case, obviously there is a red flag associated. So for all those who've been listed there in that watch list, to get themselves delisted from that and also to ensure that there is defreezing of their accounts, the competent authority is the FIO India. You can file an application in the format that has been prescribed, along with the cogent reasons why delisting is required. We're supposed to be delisted from the watch list. So this is just for the education point of view. I think this was all about reporting entities. I have made an endeavor to, give you a bird's eye overview of, the reporting entities, the ambit thereof, the obligations that are supposed to be complied with, the nuances in terms of what practically, we are facing these days, what kind of examples we have witnessed thus far from both the investigative point of view and from both the as also from the defense point of view in terms of the case that we are dealing and that we have dealt with in the past. So far as reporting is concerned, a dereliction therein would obviously not just invite penalty, but as I said, the reputational risk that it entails. Any other question that any other participant would like to post, I would love to answer the queries. And if in any case, due to some inhibition or due to some technical error, if I have not been able, if there are certain questions that could not have been posed, you can reach out to me on my email as well. And could also call me. I'm available, and I would love to answer your queries.
Yes, thank you, sir, for this insightful and thought-provoking session. We can wait for another a minute if any participant wants to type in their question.
Sure, sure.
Yes, so we have got another question
Yes.
from Tejaswini. Is registration needs to be taken separately for every type of services of which PMLA is applicable, like separate registration for cash transaction and another again a
So
separate
registration
registration for other
registration
things?
would registration would that of the entity, that would be of the reporting entity. So that is one thing that on the Finnet portal you get once you get yourself registered, and then accordingly the reports that are there, reports there are different kind of reports that are to be submitted periodically. The time limit, the time stipulated for submission of that reports, have accordingly I think I've deliberated on that aspect. So that is there. So it's just one it's like a one time activity. Once the registration is done, thereafter you can continue to submit your reports.
Yes. Another question is from Krishnan TS. What would be the requirements for a CA without a law background to get into AMLA related careers?
I would say, uh, see, as of now, we've not been able to adopt that interdisciplinary approach that is per se required in the Indian system that we are into. I would say that a person who is a qualified CA professional can definitely pursue law, but then you know it's an impediment. You can't just pursue both of them. So if you have obtained a license from the Bar Council of India and tomorrow you want to pursue CA and you become a qualified CA professional, you have a license, you have a certificate, you have a registration with the ICI. you can only pursue either. But then what additional advantage it gives you? So being a qualified CA, being a professional CA who also has a legal, you can say, who also is a qualified lawyer per se, and has pursued law, the bachelor's program thereof, he will at least be acquainted of with the legal aspect, which is I would say the legal issues that are involved, and would have a better understanding of the applicability of the law to whatever he's dealing with. So goes for a lawyer also, in case he has that you can say the acumen to comprehend numbers that easily, which chartered professionals are blessed with, I would say, because in the kind of practice that we are into, definitely we at times are dependent upon the chartered accountant professionals to go through and to screen the voluminous financials that we are bombarded with by the clients. And I'm so blessed with when it comes to working in this vertical, and the kind of assistance that I get, and the association that we have with all the practicing CAs in the firm, and the relentless efforts I think that they have put in to make our task easy. A lawyer would be in a position to build up a defense once he is able to understand the facts and the financials comprehensively. So this is a very good, I think, combination so far as the litigative perspective is concerned. But given the, you can say, the regulations that we have that governs the professions, be it legal profession, be it the profession of a chartered accountant, the interdisciplinary approach is the need of the hour, which needs statutory recognition. That's my answer to that. And additional knowledge is anytime welcomed.
Yes, I think so. We are done with all the questions. Thank you so much. Your clarity on the reporting entity obligations, risk of non-compliance, and emerging enforcement trends has given all of us a stronger perspective on how to navigate the PMLA framework with confidence. Thank you, sir, and we look forward to hosting you again.
Thank you so much. I thank Tax Sutra. I thank all the participants who have taken out time to attend this special session. Thank you. Thank you once again. Thank you so much.